Hi, ladies and gentlemen. Thanks very much for tuning in once again to another episode of When Andrew Met. This is going to be a bit different. My issue at this moment in time is the search of income. And I think a lot of investors who are looking for an income and a sustainable income are going to find it rather difficult moving forward. So today, who I've been able to bring in is Stephen Anness. Now, he's head of global equities at Invesco and runs the Global Equity Income Fund there. So a fantastic person to be able to talk to. And yeah, thanks very much for turning up today, Stephen. How's everything in Henley, first off?
Well, Andrew, great to be here. Thank you very much for having me on. Yeah, things in Henley are pretty good, to be honest. We've sort of started the process of reopening the office, which has been great to see some colleagues again. As you can probably see from the backdrop, I'm working at home today. It's sort of my my shift to be at home effectively. But no, all is well. Thank you very much.
Fantastic. Kicking off today, why would you say the search for income has been so difficult in today's market conditions?
I think, that's a big question, and I think if you look back, really, it started 10 years ago. I mean, when we, in the GFC, we saw tremendous cuts in interest rates, and I think over the last sort of decade, really, people have expected a normalization in interest rates, which we sort of began to see at various points in time. But clearly, it was very difficult for the sort of world economy to take rising interest rates, and we saw quite quickly the economic effect of that, and we saw some pretty sharp backtracking from policymakers. So, as policy rates have fallen to zero or even below zero in some cases, that has brought down yields on fixed income securities, and also clearly, a number of equities that were pretty bond-like have also followed that trajectory down. So I think it's a really good question at the moment. If you want resilient income, where do you find that? It's pretty hard. You have to sort of move out on the risk spectrum to some degree potentially, but with risk-free rates, in the US 10-year at 70 basis points, there's not that is clearly a challenge in the way that I think a lot of portfolios have historically been constructed, with fixed income being a big significant part of those portfolios.
Is there any hope? Are there any opportunities?
Look, I think so. Look, and you might accuse me certainly of talking my own book here, but look, I think equity income provides the opportunity for both real income growth and also capital growth. And I think that's a pretty rare combination in this world, frankly. Now, look, I think within that, though, I must be clear, you've got to be really careful, because there are a number of equities which would reside in the sort of high dividend yield index. So there's various indices are constructed, and the high dividend yield index, I think, has been underperforming now since 2017. And the reason is, I think, is that a number of companies within that index are what I would describe as value traps. So a lot of companies where the outlook for those businesses is challenged, and really the dividends have just become unsustainable, and the market's worked that out. And so the yields might look optically high, but the chance of you actually receiving that expected dividend, I think, are very low. And so I think you've got to be very careful about the types of businesses that you buy. You want to buy businesses that have sustainable business models going forward, can grow, can deliver profitability and cash generation to keep growing your dividend on a per share basis. And that's the thing that we focus on: is my dividend from this business likely to be higher in 5 or 10 years than it is now? And growing that income on a per share basis is critical. But there are lots of businesses out there doing it now. I think as I mentioned, there are some higher yielding stocks which I think are very much in the value trap category, but there are a number of businesses where yields are perhaps between 2 to 4%, depending which geography you're looking at. Yields in the US typically are a bit lower. But I think those businesses can deliver very strong earnings growth and subsequently dividend growth over the next number of years. Strong balance sheets, ability to deploy capital, and sort of keep that virtuous circle going. And so I think it's probably right for investors to expect a slightly lower starting yield, but perhaps with more growth in the future, rather than a higher yield to start with, and then the risk of sort of dividend cuts and actually realized income not quite matching up to the hope at the beginning.
Am I right in saying that you would suggest for income investors, it's important to take an active approach as opposed to simply buying a broad index?
Yes, look, I think so. And I mean, that's, if you think about the construction of different indices, I think, if you look at the UK, for instance, right, that, and I think, we're probably, we're all typically home biased, right, UK investors, but the UK is an index where, large proportions of that index are made up of companies that you might put in the value camp, right? So you might say energy is being disrupted, you might say some financial services are being disrupted, and obviously, given regulatory pressure this year, banks were forced to cut dividends. Some of the large telco businesses that have grappled again with growing their companies. So that's a sort of, it optically looks like a good index from an income perspective, but perhaps there are too many value traps within it, and you've got to tread very carefully in the UK. We own a number of things in the UK, but not really in those categories that I've mentioned. On the other side, you've got the US, where you'd say, well, actually, that's an index which is very heavily skewed towards tech, very low levels of dividend income. So again, just buying a broad index doesn't really help you from an income perspective, because when 25 to 30% of the index is made up of zero dividend paying equities, it's not particularly helpful, clearly. So we've tried to sort of tread a path between, I mean, look, we're very much global. I mean, half the fund is in the US, but not really in those big tech companies. We have, but there are sort of almost second derivatives of that I think you can become involved with. So we have a quite significant position in some of the semiconductor businesses. So TSMC in Asia, Texas Instruments in the US, those kinds of businesses, they produce huge amounts of cash flow, really strong balance sheets, really strong dividends. And whilst they're not at the vanguard of the highest growth companies, these are companies that we think over time should deliver sort of high single digit to mid-teens sorts of earnings and dividend growth, over a sort of 3 to 5 year period, which we think is, a really attractive place to be, particularly when your starting dividend yield is around sort of 2.8 to 3.2%, that kind of range. So we do think there's a path, as I say, by selecting really carefully from different indices through the world to find those good businesses that are on sale with attractive income streams.
Yeah, you mentioned a few stocks there. Have you had to make much in the way of changes during the pandemic to the portfolio? Are there any thoughts about where you're going to be moving the portfolio to?
We did make quite a few changes through the pandemic, and really we tried to just take advantage. I used the phrase in the last question of buying good companies on sale, and that's sort of really true to what we do. And so there were companies such as Home Depot, the US DIY retailer, which was likely to be a beneficiary of this period. It had always been a little bit expensive for us, but actually fell to a level we were comfortable with. So there have been examples such as that. Similarly, Coca-Cola, it has a very attractive 3.5% dividend. Relative performance has been poor, frankly, over the last bit of time, because quite a significant proportion of their revenue base is consumed out of home. So a fair few changes through the process. Where we go from here, look, I think there's that's a very good question. I think ties back into part of this income issue, which is that with fixed income securities where they are, and some of the most bond-like equities, I think one of the big questions that we all have to answer as investors over the next sort of 5 to 10 years, and perhaps even nearer term than that, is what kind of impact will the policy response that we have had through this COVID pandemic, what kind of impact is that going to have in the long term? And there are a number of very bright economists suggesting that actually things have changed quite significantly now. You've got a huge amount of fiscal policy, you've got money supply that is at multi-decade highs. And I think in some respects, I would argue the market's been a little bit complacent about that. Clearly, the near-term forces are very deflationary in terms of recession and unemployment, but equally, that policy shift to a more fiscally driven policy, combined with that very, very significant money supply increase, could begin to impact the way that perhaps inflation is perceived. And the Fed and other central banks are beginning, clearly the Fed most obviously, beginning to talk about letting inflation run hot. And that's whether they can achieve that or not, we could debate for most of the day. But nevertheless, that's a stated policy aim. And with fixed income securities where they are, to me, that feels like a definite risk. And therefore, I want businesses that can sustain their profitability and cash flow in real terms. So can these businesses deliver pricing power? Can they continue to demonstrate clear competitive advantages and take market share within their given industry? That's the kind of business that we want to invest in. So I think Coke's a good example of that. Yes, I accept that we do need the world to sort of continue healing from this COVID challenge. We need people to go out. We need people to socialize. But Coke is the kind of business that typically would have pricing power. So that kind of company we feel fits very well with what we're looking for at the moment, which are businesses with decent starting dividends and can grow those through the business being a very good business, frankly.
To finish off, my social media feed, it probably tells you more about my social media, to be perfectly honest, is dominated by growth versus value, with a lot of value managers showing charts, chart of the day, chart of the week. You look at the outperformance, look at the dispersion, all that kind of stuff. I'm assuming there needs to be a time where the differential between growth and value will close. Do you have a view on where do you think that would be, where that would come from?
I'm probably going to slightly disappoint you here, Andrew. I'm going to say, look, we're focused very much on valuation.
Yeah.
Right? And I've never really subscribed too much to the value versus growth. Look, I fully subscribe to the view that at times the market elastic becomes stretched between different components of the market. But we've always said that we're quite happy to pay up for really good businesses if they deserve it, and equally we're happy to buy some really cheap businesses if we feel like the assets are undervalued. I think one of the differences that I would mention though is that when I started my career after the tech boom of 2000, in 2002 or 2001 and 2, the companies with attractive dividend yields were actually really, really good companies. That's the thing. Yes, they were cheap, they were underpriced, but they were really good companies. So there's some of the consumer staples companies. Back then it was things like tobacco, some of the beverage companies as well. They were sort of the old economy companies, utilities. They were very cheap and very good companies. I think now you have a slightly different set of circumstances, which is you have some really cheap companies, but by and large, a lot of them are cheap for a reason. And so, as I say, we're trying to sort of find that middle ground, really, where we're saying, look, we think these are underpriced. We're not getting caught up in, speculation in some of the highest growth US companies for sure. But look, as I mentioned, things like TSMC, Texas Instruments, I mean, you certainly wouldn't describe them as value. But we do believe that their valuations are attractive in the context of the intrinsic worth of those businesses.
Oh, it's fantastic. No, that's great. I think we spoke beforehand, and the need to have a sensible approach to income, to look after the income, and then also look after the capital base as well. And obviously you have that as a key focus of the strategy moving forward. And yes, it resonates. It's something that I genuinely believe is important. Thank you very much for your time. Really, really appreciate it. I am sure we will catch up soon, but you take care down in Henley, and I'm sure we'll catch up in a short while. Thanks very much.
Thanks very much. Good to chat.